The Economic Times published a report that should have stopped every financial news outlet dead in their tracks. JPMorgan Chase, the bank that spent decades suppressing silver prices, the institution that paid $920 million in fines for precious metals manipulation, the entity accused of running the largest naked short position in commodity market history, just flipped sides. Between June and October of this year, they closed their entire 200 million ounce paper short position. But they didn't just exit the market, they went on the biggest physical silver accumulation spree in modern history. 50 million ounces. That's not a typo. 750 million ounces of actual deliverable physical silver. Not paper contracts, not ETF shares. Real metal sitting in real vaults under real security. Let me put that in perspective for you. That's nearly equivalent to 1 full year of global mine production. That's more silver than most countries hold in their strategic reserves. That's $22 billion at today's prices. And remember, that's their entry cost before silver truly breaks out. This is not some hedge fund making a speculative bet. This is JPMorgan Chase, a bank with $3.9 trillion in assets, deploying capital on a scale that suggests they're not positioning for a trade. They're positioning for a transformation. Think about what this means. For decades, JPMorgan has been the single most powerful force holding silver prices down through derivatives manipulation. Traders have a name for it, the JPMorgan short. It's become legendary in precious metal circles. Every time silver tried to rally toward $30, $35, or $40 per ounce, enormous paper sell orders would mysteriously materialize on the Comex exchange, crushing momentum and sending retail investors scrambling for the exits. Now, zero short contracts. For the first time in recorded history, JPMorgan is long in both physical and paper simultaneously. This isn't a hedge. This isn't a balanced portfolio position. This is a declaration of war, except they've switched sides because they know exactly what's coming. Here's what JPMorgan figured out before everyone else. The mathematical trap is no longer escapable through paper manipulation. Let me show you the 3 dominoes that are already falling one by one. The first domino, physical supply has vanished from the market. Silver lease rates, that's the cost to borrow physical metal from holders, spiked to 35% in October 2025. Think about what that number actually means. Banks are so desperate for physical silver that they're paying 35% annualized interest just to borrow it temporarily, just to have possession of the metal for a few months. One market insider told Bloomberg, "Nobody's got silver." Lease rates are 20 to 30% if you're lucky enough to find a lender. This isn't normal market stress. This is what systemic breakdown looks like before the headlines catch up. The second domino, Comex registered inventories, the metal actually available for delivery against futures contracts, have collapsed to 15-year lows. At the same time, open interest has exploded. The exchange is now operating at a 244% ratio of paper claims to physical metal. Let me translate that for you. For every ounce of silver that's actually sitting in a Comex vault available for delivery, there are 2.44 paper contracts claiming ownership of that same ounce. This is not a functioning market. This is musical chairs where more than half the participants won't have a seat when the music stops. The third domino, industrial demand is no longer optional, and it's accelerating. Solar panels, electric vehicles, 5G infrastructure, data centers. These technologies consumed 1.2 billion ounces in 25 alone. Unlike investment demand that can pause during economic downturns, industrial consumption is locked in years in advance. Manufacturers can't build solar panels without silver paste for conductors. JPMorgan looked at these 3 data points converging and reached an inescapable conclusion. The suppression game is mathematically over. The bank that made billions shorting silver for decades just deployed $22 billion to go long because the fundamental equation has permanently inverted. They're not fighting the tide anymore. They're positioning to profit from the flood they know is coming. And here's the critical detail that should terrify anyone holding paper silver or sitting on the sidelines waiting for a better entry point. JPMorgan's flip coincided exactly with the US Mint announcing they're running out of silver coins. Think about that for a moment. The United States Mint, backed by the world's reserve currency with direct relationships to every major silver refiner and mining company on the planet, can't source enough silver to meet retail demand for American Silver Eagles. If the US Mint is struggling to find physical silver, What chance does a retail investor have when they try to convert their paper ETF shares to actual deliverable metal? Silver is trading at $64.47 today. That's already an all-time record high. But if JPMorgan is willing to deploy $22 billion at these prices, what do their internal proprietary models show silver reaching when the supply crisis becomes undeniable to the broader market? The difference between 1980, when the Hunt brothers tried to corner silver and spectacularly failed, and now comes down to one critical distinction. The Hunts used leverage and paper contracts backed by credit lines. JPMorgan is hoarding physical metal purchased with balance sheet capital. The government forced the Hunt brothers to liquidate by changing margin rules and freezing their credit. But you can't force JPMorgan to sell bars physically, sitting in their vaults. There's no margin call on metal you actually own. There's no regulatory mechanism to compel sale of privately held commodity inventory without invoking national emergency powers. Let's go back to where this story really begins. 2011. That's when JPMorgan was suddenly and quietly approved to establish their own Comex silver vault, becoming one of only 5 approved depositories at the time. They started from absolute zero, no silver inventory whatsoever. By 2017, just 6 years later, they controlled 112.5 million ounces out of a total Comex inventory of 213.3 million ounces. Do the math on that for a second. That's 53% of all the silver backing the world's largest paper silver derivatives exchange held by a single bank with a documented, proven, legally prosecuted history of price manipulation. This wasn't random accumulation. This was a coordinated multi-year strategy executed with surgical precision to position themselves at the absolute choke point of global silver supply. Industry analyst Ted Butler tracked their accumulation patterns for years and found something remarkable in the data. JPMorgan systematically stopped delivery on Comex contracts, meaning whenever they held long positions, they demanded physical silver instead of rolling contracts forward or taking cash settlement like most traders do. Between 2015 and 2010 alone, they took net delivery of 51 million ounces. In March 2017, they stopped 2,689 contracts representing 13.4 million ounces, well in excess of Comex position limits that supposedly exist to prevent market manipulation. Ted Butler actually filed a formal complaint with the CFTC about this pattern. Nothing happened, no investigation, no enforcement action, no public comment. Why? Because JPMorgan wasn't breaking the system at that point. They were quietly preparing for the day when the system would break itself under the weight of mathematical impossibility. Fast forward to 25, and the official government data now proves what Butler was warning about for years. The Commitment of Traders Report, COOT, the CFTC's weekly snapshot showing who's positioned where in futures markets, reveals something extraordinary happening in real time. In one reporting week alone, the commercial net short position, which is primarily the big banks like JPMorgan, HSBC, Deutsche Bank, dropped by an eye-watering 15,564 contracts. That represents 77.8 million troy ounces of paper silver. Analyst Ed Steer, who's been tracking silver manipulation for 2 decades, estimated the commercial short reduction would be at most 5,000 to 10,000 contracts based on historical patterns. The actual number was 15,564 contracts. At the exact same time, managed money, the CFTC's category for hedge funds and speculators, went aggressively net short. This is extremely rare and historically significant. Now the positions have completely inverted. Smart money with inside information is long, while dumb money chasing momentum is short. Analyst John Rubino from Dollar Collapse called this pattern hyper-bullish and noted, "This is something very seldom seen, and commercial's almost imbalance is also unusual." Translation, the banks have stopped fighting the silver rally. They've stopped using derivatives to cap prices. They're now positioned to ride the wave they spent decades suppressing. But here's the most damning piece of evidence that the physical market has already broken beneath the surface where most investors aren't looking. October 8th, 2025, a buyer, widely rumored in trading circles to be India, placed an order for 1,000 tons of silver on the London market. This roughly 32 million ounces. To be completely clear about scale here, that's not even a % of annual global mine production. The result? The London Bullion Market Association reported 844 million ounces of silver in their vaults at the time. Yet, the market couldn't deliver 1,000 tons without completely seizing up. Silver lease rates instantaneously spiked from 0.25% to 200%. Every major trading desk withdrew liquidity from the market simultaneously. Swiss refiner Metalor, one of the three largest precious metals processors in the world, announced they would not return to silver trading until January 2026. The LBMA claimed to have 23,926 tons of silver sitting in London vaults. An order for 1,000 tons, barely 4% of claimed inventory, caused total market paralysis. Why would that happen if the metal is really there? Because, according to the LBMA's own accounting standards, 4/5 of that claimed inventory is allocated to ETFs like SLV and theoretically not available for immediate sale or delivery. The October 8th freeze answered that question definitively. The silver isn't there. Not in the quantities claimed on paper, not available for delivery on demand without causing systemic stress. Between June and October 2025, JPMorgan executed their complete position flip with the kind of precision you'd expect from an institution that trades trillions of dollars across global markets every day. First, they systematically closed the short position. 200 million ounces of paper contracts were bought back over a 4-month period. But they didn't stop there. They simultaneously deployed the capital freed up from closing those shorts to accumulate physical metal at a pace that's almost hard to comprehend. In just 6 weeks during this period, they added 21 million ounces to their stockpile. That's 300,000 ounces per day for 6 weeks straight. Where did they source that much physical silver while the market was already demonstrably tight? Comex registered vaults, ETF custodian inventories like SLV's holdings, private off-market deals, directly with mining companies and industrial holders. When you're JPMorgan Chase with $3.9 trillion in assets and relationships with every major financial institution on the planet, you can make calls that retail investors can't. Let's do the exact math that JPMorgan's quantitative analyst did before their executives approved deploying $22 billion of shareholder capital. Start with supply. Global mine production for 2025 comes in at 835 million ounces. Industrial consumption alone, 1.2 billion ounces consumed in 2025. Solar panels, electric vehicles, 5G infrastructure, data centers, semiconductor manufacturing. These are supply chain requirements locked in 3 to 5 years in advance. Structural deficit, 117.6 million ounces for 2025 alone. This is the 6th consecutive year that global demand has exceeded mine supply. Comex registered inventory, the metal actually available for delivery against futures contracts, has collapsed to approximately 38 to 40 million ounces as of Q4 2025. Meanwhile, open interest, which represents the total number of outstanding paper contracts, exceeds 244% of that physical inventory. Translation: if even 41% of contract holders standing for delivery demand physical metal instead of cash settlement, Comex cannot fulfill those delivery obligations with existing registered inventory. The exchange would face a binary choice: source metal or admit publicly that they cannot fulfill delivery on contracts they sold. This is structural insolvency. JPMorgan deployed $22 billion at prices averaging $60 to $65 per ounce. Why would they do that if silver is expensive at all-time highs? Because their proprietary models show something dramatically higher coming. Let's use historical precedent. In 1980, silver peaked at $50 per ounce. Adjusted for official CPI inflation, that equals approximately $185 in today's purchasing power. If you use actual inflation metrics, the methodology the Bureau of Labor Statistics used before they changed their calculations in the 1990s, 1980's $50 silver equals roughly $600 per ounce in today's dollars. But here's the critical difference. In 1980, the Hunt brothers tried to corner silver using 200 million ounces of leveraged paper positions. Today, industrial demand alone consumes 6 times that amount annually, and its structural consumption, 3 specific dates should be permanently marked. January 2026, China's new silver export control regulations take full legal effect. If Beijing decides to curtail or completely halt exports, that removes a significant percentage of global supply overnight. Also, JPMorgan must return the 4,000 tons of silver they reportedly leased from ICBC. On February 2026, the next major Comex delivery cycle begins with the March 26 contract. With registered inventory at 15-year lows and open interest at near record highs, this will be the first major stress test of whether Comex can still function as a legitimate physical delivery market. Here's what JPMorgan knew that they deliberately didn't tell retail investors. The paper-silver market is already mathematically broken. The October 8th London freeze proved it beyond doubt. The 35% lease rates proved it. The US mint coin shortage proved it. The supply deficit mathematics proved it. While they spent decades telling the world silver was going lower, they were simultaneously building the world's largest physical stockpile in secret. Silver is at $64.47 today. Every mainstream financial analyst will tell you it's too expensive. You missed the rally. Wait for a pullback to $50. Meanwhile, JPMorgan just deployed $22 billion at these exact prices. Who do you trust? Financial media, whose business model depends on retail investors staying complacent, or the bank that manipulated silver for decades, suddenly going all in long with their own money? 50 million ounces deployed, $22 billion used, 0 short contracts remaining. When the biggest predator switches sides, it's not a warning, it's a certainty. Subscribe and turn on notifications. Because there are 3 weeks until January 1st. You must not remain disconnected from information and developments, as the market never stops.